So good morning, everyone. I think Schedule 3 is anyway a common domain expertise expected from all of us. I think we are all auditors or probably in some form playing the role of an accountant in corporations, etc. I'm sure it is going to be useful. So what we will do is, I mean, the intent is not to cover Schedule 3 per se, but I think the objective is to discuss some of the concerns that generally arise when we try to apply Schedule 3 as part of the presentation and disclosure of financial statements for corporates. So these are specific examples, disclosure matters, clarifications, multiple interpretations, etc., that actually come out when we really apply Schedule 3 as part of presentation and disclosures. So we will look at what the actual provisions are, what is the general interpretations, what are multiple interpretations that are prevalent currently, and how do we really resolve it in the best possible way. I'll use some of my practical experiences based on my role as an auditor, and we can then deliberate if required. The first one is in relation to capital commitment. As you're aware, Schedule 3 requires disclosures pertaining to various commitments, including capital commitments, which are not provided for. So if you look at capital commitment definition, it is in relation to a future liability for capital expenditure, in respect of which contracts have already been entered in. So the contract is already in place, and then obviously, you've paid some capital advances, and the purchase order value is much higher than the capital advance. So the difference between the purchase order value and the capital advance is recorded as is disclosed as a capital commitment in the financial statements. So here, the intent is to capture all open purchase orders. Even though we say that all open purchase orders need to be covered, you need to deduct the capital advance and then show the differential amount as capital commitment in the financial statements. It is not very easy to capture this data because some of these ERP packages, we'll come to the challenges. So if you look at some of these ERP packages, they do not have a mechanism to capture all the open purchase orders. And because of that, obviously, we are not able to map the total open purchase order value and the capital advances and then derive the capital commitment number. So it was also observed that there are companies who had capital advance. So obviously, the first question would be, if you have a capital advance, have you evaluated it for any capital commitment disclosure? So that's the first question as an auditor or as an accountant who's preparing a financial statement would have. So then it tends to be a miss out. So here what we should do is, if you're an auditor or even if you're an accountant, you should first look at the controls around capturing this data. So even with the ERP package, along with ERP, what controls does the company have in terms of the design? How is it designed for capturing? And am I audible to everyone? Hello, is this better? Okay. Okay, cool. So coming back to capital commitment, what we then do is, first of all, we look at the controls. I think that is the primary thing that we look at as an accountant and also as an auditor in terms of what are the controls that exist around capturing the data. How does the management really capture the data? What systems do they have in terms of ensuring that all the open purchase orders are there on record, basis which the capital commitment can be captured. And then looking at the specific FSLIs, the financial statement line items, like for capital advance, if there is a capital advance, then we really see whether it is 100% capital advance that has been paid against the purchase order, or if there are certain amounts which are not yet paid. Then in that case, obviously the difference will be reflected as a capital commitment. The next item we will cover is capital work in progress and intangible assets under development. Again, as you're aware, we need to have an aging schedule. Yeah, you can. Either ways, it will be easier. We can resolve it upfront. So here again, if no, monetize in the sense you're talking about the disclosure of. So cost overrun, again for cost overrun, if there is a purchase order. So the primary thing is you need to have a document in place. If you do not have a new purchase order or an amended purchase order or a revised purchase order, then for all practical purposes that commitment doesn't exist because you do not have a contractual doc. So it's important to have that purchase order, and basis the revised purchase order, again you see what is the quantum of capital advance that has been paid against that purchase order, and then the difference. If nothing has been paid, the entire thing becomes a capital commitment. Like the differential, as you said, if there's a cost overrun and you have raised a amended purchase order or an updated purchase order and there is no capital advance, then the entire thing is capital commitment. Sure. So So interest is separate because that's not the primary capital thing. On the escalation piece, again, you'll have to see the probability factor. So if at a stage where the purchase order is more like an open purchase order, which says that with a plus minus 10% variation, and there is a high probability that this is going to be the real order value, then that becomes your revised order value, and then you benchmark your capital advance and disclose your capital commitment. So in terms of CWIP and intangible assets under development, as you're aware, there is a requirement to disclose the aging schedule for both of them. And again, wherever the completion is overdue, here again the requirement is to indicate the fact that it is overdue and to what extent it is overdue. And wherever there is an there is an escalation and obviously there is a cost overrun as compared to the original budget, that again needs to be disclosed, and the quantum, to what extent the overrun is there. So here, I think there are generally challenges in terms of disclosing the expected completion timelines, because we are talking about something that's expected to be completed on a project. So there is an estimation process. So here, there are challenges, there are discretionary principles applied here. So any variation between a project's actual completion timeline or its actual cost versus the original estimate is something that we look at from the original plan, and then we make the relevant disclosure saying that this is the cost overrun or this is the time overrun, etc., etc. There is a clear definition in terms of what company's original plan is. So that is the plan which is approved by the relevant authorities. So if it's a board of directors, then obviously the plan should have been approved by the board of directors, basis which you will come to know what is the timeline and what is the budgeted cost. And then obviously that is the benchmark against which both your cost overruns and your time overruns are estimated and the relevant disclosures are made. Now here, this again, the challenge is tracking it. So you might want to disclose everything, but really what is a cost overrun and what is the original plan and what is the rigor with which the original plan was made. So this process of budgeting and timelines, etc., people have various processes, and across industries it differs, and depending on the system that a company has, the internal control framework, etc., there might be challenges in this. So that's why obviously there are challenges in terms of ensuring the completeness of CWIP and intangible assets under development related disclosures. So here again, you need to have an understanding of controls around derivation of this information and the maker-checker policies, because obviously there has to be a proper review role in terms of whatever is captured in the financial statements, and comparison of the revised plan, if any, and the original plan. So there has to be a documented original plan. Sometimes you also realize that there is no formal original plan. So then what do you really benchmark your revision against? So there has to be a documented original plan, and then you look at the revised plan, which again should be documented, basis which then you can determine the cost overruns. Otherwise it becomes like, what is the cost overrun or what is the time overrun? How many days, how many years? Or so there again, a documentation trail has to be there. You need to ensure that you get this in place so that the relevant disclosures can be made. And these are challenges. We are talking about it very smoothly. I'm sure a lot of you who are auditors would have dealt with your clients and then would have found some difficulties in really obtaining the information. Mutual fund investments. I mean, again, a very, very common problem in terms of how do we really interpret mutual fund? Should we call it quoted or should we not call it quoted? If you look at Schedule 3, there is a requirement to disclose the aggregate amount of quoted investments, okay, and the market value thereof. Because it's quoted, obviously the market value disclosure is something that we need to do, and then the unquoted investments is also. Now, quoted investments is not defined in Schedule 3, but there was a definition in the pre-revised Schedule 6, and that is what most of us pull from. So the pre-revised Schedule 6 meant, it defined that it is an investment in respect of which there has been granted a quotation or permission to deal on a recognized stock exchange. So if you look at mutual fund per se, it is not something that is dealt on a recognized. Here, when we talk about recognized stock exchange, generally those are equity securities or your debt-related securities, etc. So those are then treated as quoted. And there is a mixed practice here. People believe mutual funds, because there is a NAV available, so in some form there is a market benchmarking. So that's why it is quoted. And that's the whole reason why a lot of people classify it as quoted. There are people who believe that no, it is not something which is traded, as a security on a recognized stock exchange, etc. Not like any other equity or debt instruments. Obviously, it is unquoted. So this practice is mixed. Obviously, whatever you do, I think you need to really ensure that there is appropriate documentation first in the financials, making it very clear that, okay, this is mutual funds and it is based on the NAV, and that is the reason why we believe it is quoted. Or if you believe it is not, and then then we go by the strict definition as per pre-revised Schedule 3. Now here, this is open to interpretation because Schedule 3 has left it open. There's no specific definition. Yeah, sorry, you have a question? Okay. Trade receivables, payables, again, aging. We need to provide aging disclosures for trade receivables. There are aging buckets and you need to bucket it. There is unbilled, there is not due. If you look at trade receivables, there are, you might, the amount also might not be due. At the same time, some of it is not even billed, so it is unbilled. So you need to have appropriate bucketing, and whatever is unbilled should be shown as unbilled, whatever is not due should be shown as not due, and whatever is less than 6 months and 1 to 2 years, etc. So that bucketing is very critical, both for payables. The next segregation is between undisputed and disputed receivables and payables. So here again, your bucketing between disputed and undisputed is important. And then the third categorization is between what is considered good, what are debts which have significant increase in credit risk. So obviously that is where you can expect, apply the expected credit loss model and determine the required ECL provision. And credit impaired, where there is generally 100% ECL provision. This has to be determined from the due date of the invoice, which is very clear as per Schedule 3. But then what is due date of the invoice? So when we look at the invoice, first of all, there has to be a date of the invoice basis which then the due date has to be mentioned. And in most cases, you will find that yes, the due date is defined. So there are terms which are agreed saying that, this is going to be the due date, etc. 30 days, 60 days, 90 days, depending on the company's terms and payment policies and generally accepted market practices. Where the due date is neither agreed in writing nor verbally. So there are some where there's a business practice. It is understood that if I sell to suppliers in this specific industry, then obviously the due date is expected to be this much. Or there is a general policy within the company where it is understood that for any transaction that we do in these particular goods or these particular services, this is the expected due date. So that is what you can look at. So even though it is not in writing, you can deem that to be the due date. And then obviously the aging related disclosures. But where there is no such due date, then the transaction date is what applies, and obviously the aging is determined based on the transaction date. So what are some of the challenges that we face? So there are due dates, obviously, but there are multiple. So there are large companies who deal with a lot of products, deal with a lot of suppliers, deal with a lot of customers, and a lot of these customers have varying credit terms, because some customers are able to extract terms which are very beneficial, which is not in line with the general company credit terms, which are not in line with credit terms, purely because of their market stature or because of their relationship, etc. And you will find that this is common in a lot of these large corporations who deal with customers of a specific stature. So that will be there. So generally what happens in such cases is, for the purpose of convenience, people then apply the transaction date and don't really go by the due date, and then the aging is done in that in line with the transaction date. But here what happens, like if there is a large group which has got multiple subsidiaries, so here again we need to have alignment around the policies for presentation and disclosure. So today when we are talking about determining the aging, then if this company is able to determine the aging based on the due date, but there are subsidiaries who do not have a refined system or who have a complex due date formula because of varying customers across jurisdictions, geographically spread, etc., then they might have a transaction date based aging. So how do you put the pieces together? So this is one challenge that we also face when we deal with multinationals who are spread across geographically. So here what we generally do is we insist on instructions being sent across to the component auditors, making it clear that this is how we are looking at from a aging perspective. So if you look at due date as the base for determining the aging, tell your component auditor that yes, this is what we are looking at. So please ensure that you have the aging captured basis the due date. If you believe there are challenges based on your historical audit experience or basis discussion with the parent company's management, parent companies, KMPs, etc., then you can change your model and say that, okay, we are going by the transaction date, then let the component auditors also do basis the transaction date, and we are able to consolidate on a like-to-like basis. Any questions till now? Yes. So generally, as you're aware, we make a provision for sales returns. So there is generally a historical trend about sales returns where we say that, okay, 2% of the goods sold or 5% of the goods sold is generally, in the form of sales returns. So based on historic trend, you determine the sales return percentage and you apply that sales return percentage and reduce your sales. Obviously, it has to be a reduction. If you look at India's 115, it has to be. So that is taken care of. And if that obviously is reduced, then obviously it will not form part of your aging bucket because obviously you're dead. So that's it. So that's what I'm saying. I mean, the first thing is you need to nip it in the bud. So since you're auditing that company, you need to first understand the group structure. Like wherever there are subsidiaries where you believe, I mean, first is this discussion with the management saying that this is the statutory requirement. We are looking at a due date based aging analysis. So management will come back to you and saying that, okay, at the parent company I can do this, but there are some subsidiaries where there could be difficulties. Now here the materiality factor is also something that we need to consider. So if your parent is like a significant component of the larger consolidated group and the other subsidiaries where this information is not available, is not material, I think you can ignore it and say that, okay, we will go based on the parent thing, and we can, even if it is not based on the due date, I will still use that aging bucket and disclose it in the finance, because it really doesn't affect your overall disclosures from a consolidated numbers perspective. But if it's a material subsidiary, then in that case, you need to ensure that it is in line with what the parent, because as you're aware, for the purpose of consolidation, the accounting policies and presentation disclosure have to be aligned. So do that. Have that conversation upfront with the component auditors, with the component management, through the parent company's management, and get it set right. If it is so material where that is going to drive the overall disclosure and the parent company related disclosures are not material, then you go by what the subsidiary is doing. So if the subsidiary is not able to derive it based on due date and transaction date is what they are going to benchmark it against, use that, and then parent company data can also be done based on. No, that's what I'm saying. So that's what you need to avoid. So if it is substantial, then have that data point upfront, have that conversation with the material subsidiary or the component, and get that data. Because a lot of this can come up at the time of planning. When you have your planning discussion, we know the Schedule 3 requirements in terms of the aging and how the aging has to be determined. With this background, you need to have that discussion with the client and tell them that, yes, this is what we need. Have a discussion with your component management and let us know whether this is possible. So they will come out and say that, okay, it is not possible there, it's only transaction date, we don't have the due date related information, or it cannot be captured easily for the purpose of disclosure. Then fair enough, you can take your decision in terms of how do you really want to handle it. Do you really want to change the parent company's disclosure in line with the transaction date, or do you want to request them to get the whole thing, or if it is not material, you can ignore it. Disputed, I think a very legal term. So, and again, as you're aware, there is a very clear requirement to disclose, debts which are disputed. trade receivables and trade payables. So that split between disputed and undisputed is very important. Now dispute, what is dispute? It's a matter of facts and circumstances. I think it depends on how you interpret it. So, and when do you call a situation as a dispute? I mean, do you really need to have filed a litigation, or is it like a mere disagreement? So, or is it like, the case is at a particular stage? I mean, it's not even, so there are various interpretations in terms of, and legality is a challenge. So that's something that you need to be conscious of, what is disputed. And secondly, once you have that definition of disputed, I think that is something that you have to uniformly apply in terms of interpreting something as disputed within this. And that again has to be based on, one, the regulatory framework that is applicable to the company, the regulatory framework of the country in which the operations are based. So if it's India, then obviously the India regulatory environment is what applies in terms of how a dispute is interpreted and what is the legal framework around interpreting something as a dispute. If it's in an overseas jurisdiction, then obviously the local jurisdiction related interpretation on what a dispute is and how is this something treated as a dispute in local parlance in line with the local regulation. So that is something that you need. And again, the industry practice, because some industries have a trigger of everything being a dispute, everything is litigative. The nature of industry is such that everything can be litigative. So you need to be very conscious in terms of what is dispute. And then that's where your professional judgment, your professional skepticism will come into play in terms of what you really need to disclose as disputed. Now another important aspect which is generally not understood in the right sense is, if it is undisputed, does it mean that it is recoverable? Not necessary. It is not disputed, but at the same time you have dealt with a party which is not in a position to pay. That could still become a doubtful debt, right? So if I'm dealing with a party which is going bankrupt or whose financial position is not good, he's not disputing my due. But the recoverability is a challenge. So obviously the ECL provision has to come. There would be a expected credit loss. So again, the mere fact that it is undisputed doesn't mean that there'll be no provision. And even where there is a significant increase in, so there are bucketing again. So there are debts which are good, there are debts which have an increase in credit risk, and there are debts which are impaired. So debts which are impaired, obviously the provision is at 100%. Where there's an significant increase in credit risk, obviously then you apply the ECL provision based on the bucketing, and then you apply that proportion on the outstanding receivable in that bucket, and you determine the ECL number. So need not be disputed, but an aging related provision, or merely because of the fact that the party is not in a position to pay. And here again, if you look at how we need to recognize revenue, even from an Ind AS 115 perspective, if the recoverability is in doubt at day one, then you don't even recognize revenue. We are talking about situations where the revenue recognition has already happened. That evaluation has been done on day one where you believed that the debt was recoverable. That's why we recorded it as a revenue. There are subsequent events basis which the debt has become irrecoverable, and that's where we then consider it for ECL provision. Yep. So that's what I said. So disputed, if you believe the dispute, so let me just explain each of them. If when you're saying disputed and you believe that your case is very weak, you have a discussion with your legal team, you have a history of similar disputes, the industry has a history of similar disputes, you look at all those data points and then determine whether it is recoverable or not. If based on that evaluation you believe it is not recoverable at all, because either your service quality was poor or the service was not of the required standard, basis which you believe that the party is not going to pay you, and even the kind of correspondences that you would have had with your parties or the legal team or their lawyer would have sent you a notice saying that these are the gaps that we found in your delivery of goods, delivery of services, the quality and terms, whatever. There could be n number of disputes, basis which you believe that these are factors basis which the recoverability is going to be a challenge, 100% provision required. Undisputed, there are no disputes, but at the same time, based on public information, today you read in the newspapers that this particular party who has to pay me money is going bankrupt. You would have received a confirmation. Okay, another confusion that people have is, if I have a confirmation from a party, that means the debt is good and recoverable. Not necessary. The confirmation is for establishing the existence of a receivable.
saying that the party acknowledges that, yes, I owe this money to you, and this is the quantum of amount, and this is the transaction, this is the invoice reference, etc. So that is a confirmation. That doesn't establish the fact that I am in a position to recover the money. The party might be going bankrupt, but he's a good party and says that, yes, I owe this money to you. But still the provision will be required. Because I've also seen interpretations where people come and say that I have a confirmation from the party. So that is very important, because this confusion, I mean, especially people who are junior in the system, they tend to look at confirmation as an assertion that, yes, the debt is good and recoverable, but that is not the case. You need to have a separate evaluation for the recoverability aspect. Bank deposits, I think we are all familiar with cash and cash equivalents, bank deposits, and then other financial assets. If you look at Schedule 3, bank deposits with more than 12 months maturity shall be disclosed under other financial assets. So the maturity has to be construed as remaining maturity, because if you look at current versus non-current classification, then it is more than 12 months, then it becomes non-current. And I mean, it's not literally more than 12 months, but which is the operating cycle. That operating cycle could be less than 2 months, but whatever you define as an operating cycle, that is what is considered for classifying something as current. But if you do not have a defined operating cycle, then generally 12 months is considered for the purpose of classifying something as current versus non-current. Bank balances other than cash and cash equivalents, they are balances held with bank as margin money. So you have some borrowings, etc., or guarantees given, basis which you have given some margin money or any kind of a security. And bank deposits with the original maturity of more than 3 months but less than 12 months. So that's where, first is if it is based on original maturity of less than 3 months, it becomes cash and cash equivalents. Beyond 3 months but less than 12 months, it is bucketed as bank balances other than cash and cash equivalents. Cash and cash equivalents not very clearly, I mean, not defined at all in Schedule 3. So, however, India 7, the standard that applies for statement of cash flows, that defines cash and cash equivalent. So obviously cash on hand, demand deposits with banks, etc. are defined as this. And plus where it has a short maturity of say 3 months, which is again aligned with how the industry looks at. So anything with an original maturity of less than 3 months is treated as cash and cash equivalents. Original maturity. So there again, I mean, that confusion is there. So is it cash and cash? Because originally it was 12 months and now it is 3. No. Original maturity, even if you look at the accounting policies, we very clearly mention that with an original maturity of less than 3 months. That is only treated as cash and cash equivalents. So good that you asked this question, because that confusion also exists in terms of whether it is the remaining maturity or... So you look at Schedule 3, then bank deposits are generally classified as bank deposits with original maturity of less than 3 months. Original maturity, so clearly cash and cash equivalents, simple. Bank deposits with original maturity of more than 3 months and remaining maturity of less than 12 months. Again, the current, non-current definition that we're talking about. So that's where we then say bank balance other than cash and cash equivalents and the current. Bank deposits with the remaining maturity of more than 12 months, other financial assets, and non-current, because it is more than 12 months. Now what happens when there are bank deposits with original maturity of more than 12 months and remaining maturity less than 12 months? So when we are talking about, as on the balance sheet date, when we are actually preparing the balance sheet, then it is, the original maturity was more than 12 months. So obviously time has passed and then you have only, suppose 5 months. So then what do? So then in that case, there is one section which classifies it as bank balances other than cash and cash equivalents. Because of that, more than 3 months and less than 3 months. There are some who look at it as other financial assets and treat it as current. Obviously current because the remaining maturity is less than 2 months. So here again there is a mixed practice, but the only recommendation here is just articulate it very clearly. Just call it whatever it is, with original maturity or with remaining maturity of 3 months, so that the reader of the financial statement is very clear what it means and what does it really indicate. So if that is there, I think either ways, even if he believes that, okay, according to me, it should be other financial assets, but he knows at the back of the mind, this is the item that I'm talking about. Because these interpretations are mixed. But if you leave it very vague, then it can be very, loosely interpreted and there could be challenge, if it is a material amount, obviously. Ratios also will be affected. So there are analysts who look at numbers, in terms of what is the cash strength, liquidity position. So there again, it might. And again, consistency is what is important. So if, you are bucketing everything based on year-end status of maturity, then bucket everything like that. So all kinds of bank balances, margin money, any kind of, it should be bucketed, you applying the same yardstick. Income tax assets and liabilities. So here again, this is a very, very common error that a lot of us tend to do. If you look at income tax assets and liabilities, what people do is they take a shortcut in terms of clubbing all. So there are multiple open assessment years, right? Assessments are not completed for long periods. We have all open assessments. So if there are suppose 10 assessment years, what people do is they bucket all of it and then show the net position. Suppose if there are 15 line items of, in one there is a receivable, one there is a payable. So all of them are clubbed together and shown as one number, which is not the right approach. Because it all depends on whether you really have the right to offset the receivable of a particular assessment year versus the payable of another assessment year. Income tax authorities generally don't allow. They will do it, okay? But as an SSC, you're not supposed to do it. After. So you need to be very careful when you are disclosing. You need to be looking at the regulatory framework that is applicable to the company. When you're talking about an Indian income tax law, we know the situation, we know how income tax authorities. So obviously you need to have that analysis assessment year wise. So for each assessment year, you determine whether it is a receivable or a payable. Suppose if there are 5 assessment years where you have receivables and there are 5 assessment years where you have payable, you club these 5 receivables together, you club these 5 payables together and show the receivable separately and the payable separately, but not all of them on a net basis. So the position becomes significantly distorted if you net it off. Unless it is very clear that you have the right to offset based on some arrangement or in some geographical area like outside India, if you believe that in that particular jurisdiction the tax authorities look at it in that manner, absolutely fair, just follow that. But as I said, if you look at the right-hand side where we spoke about income tax authorities, if you have, there is a refund order, what they also look at is there a demand against another assessment year? They will then offset it. But even for your books, you are not supposed to be doing it. Okay, so I think we have to be very clear in terms of what is the statutory authority doing and what you are. If it is a closed order where they've said that, okay, now I'm closing both these assessment years because I have this refund and I'm offsetting it against my liability, you can close it. For you, then both these assessment years are closed. But if you do not have a closure, then you continue with your disclosure of showing each of them separately. So your constructive obligation principle is something that we have to look at. So just be very clear in terms of what is the obligation that we have and how is the statutory interpretation around some of these statutory obligations. Yes, sorry. Yes. Sorry, I can't hear you properly. When the order is received and you have accepted, your assessment is closed, right? So then you can show it on a net basis, you can knock off everything in relation to that. So if you have an asset, the money is received, and if it is received fully, then the amount is anyway knocked off. Because you have a receivable from income tax authorities, the money is received, it becomes zero. If you have partially received it, and you still believe it, the balance amount is receivable, then you keep it as open. But if you believe it's a full and final settlement from the income tax authorities, then the balance amount has to be written off. At the same time, if there is a payable, and there is a final order which says that against 100 you have to pay 150, then that 100 is what will be shown as a knockoff against your payable, and the balance 50 could either be interest, penalty, or additional liability. Depending on that, you need to show whether it is an interest charge or a penalty charge or a additional income tax liability. If it is an additional, then it will go to income tax adjustment in respect of earlier years. So obviously the presentation has to be very clear depending on how the order describes the payable or receivable has. Promoter shareholding, again a very sensitive topic, and again multiple interpretations possible. So as you're aware, companies are required to have separate disclosure of shareholding of promoters. There's a prescribed format that we need to follow. And promoter again is as defined in the Companies Act. So who is a promoter? Promoter, first of all, if he's named as a promoter in the prospectus, then obviously he is a promoter. If somebody is starting a company and says, like, okay, there is a prospectus, which is a public document, he's called as a promoter, he's a promoter. Or he's identified by the company in the annual return that is being filed, section 92. So there, if somebody is called a promoter, then obviously he is a promoter, because that's an information in public domain, and basis that then somebody is called a promoter. Again, a person who has control over the affairs of the company, directly or indirectly. I mean, somebody who's a stakeholder, somebody who is, a promoter will definitely drive the business, because that's his company, right? So if there is obvious indication of control over the affairs of the company, directly or indirectly again could be through nominee directors, through his board, which actually operates under his direction. So then obviously it is obviously deemed to be a promoter. And in accordance with whose advice, directions, or instructions the board of directors of the company is accustomed to act. So if there is a promoter who finally is the ultimate authority in terms of decision making, he has a veto power, he uses that veto power even though there is a board. Obviously the board is more like an advisory board, has to play that role of a board in line with the Companies Act. But at the same time, if the promoter is got some of those specific authorities, veto powers, etc., basis which he's able to decide, then obviously he's a promoter. But obviously, this does not apply to a person who is acting in a professional capacity. So obviously, if there is a person who's playing that role based on advisory, this, etc., so then he's out. So we've looked at the definitions, but what happens is sometimes the information that is available in the public domain. So there are different sections. If you look at the annual return, there are various sections for promoter and promoter group. And there, based on what the form tells you to do, people fill it. And that need not match with the disclosure in the financial statements. Under equity share capital, where we put the promoters and the related promoter shareholding, so that gap could be there. So here you need to be very clear, like suppose if when we look at the corporate governance report, so there we give a detailed breakup of each of the shareholders, the category of shareholders. There are financial institutions, there are domestic institutional investors, there are public shareholders, there are promoters, and then there's a larger promoter group within each of them, and then we club it together. So there, it is important to bring it out very clearly, so that, again, I'm saying that if somebody wants to interpret it or do some working around it, the person is able to do it. If there are disconnects between the annual return and what is disclosed in the financial statements, because here we are on Schedule 3 disclosures, which is there in the financial statements. So there has to be alignment between all the regulatory filings that are there. Remeasurement gain and loss, this, if you remember, 2023, there was this specific amendment. Now, here, I mean, as per Schedule 3, it has to be recognized as a part of retained earnings, right, with separate disclosure. So the problem that generally arises is, yes, people show it as part of retained earnings, but there has to be a separate disclosure around remeasurement gains. So either you have a note in the statement of changes in equity saying that this is the amount of remeasurement gains which is included as part of retained earnings, or you have a separate column for, you finally bucket it under retained earnings, but as part of retained earnings, you show it as a separate column. So that separate disclosure which is required by Schedule 3 is generally missing. That is what, if you see some of these public financial statements, that's where this is missing. And again, as I said, 2023, that amendment was there, but people don't seem to be. So first of all, a lot of people don't even have the data, because historically they've always been putting it under retained earnings, so that carve out has never been done. So obviously they don't tend to do it, and they continue with their historical disclosure. But that is a non-compliant. If the amount is material, again, materiality is inherent to everything that we do, whether it is recognition, whether it is presentation, disclosure, etc. So materiality is the first factor that we apply. If it is material, then all of these things become relevant, because then obviously, information in public domain is not right. So this is something that might affect the view of the readers of the financial statements. So with that background in mind, you need to decide whether you really need to give those disclosures and how important or how significant it is for us to really ensure disclosures. Borrowings. Schedule 3 requires us to show terms of repayment of term loans and other loans. Okay. And other loans, any non-term based loans is other loans. Anything which is in the nature of borrowing is other loans, and obviously all the related disclosures have to be there. And generally for non-current borrowings, we have to have all those disclosures in terms of repayment. And again, so you might have various loans, but all of them might have similar terms. So you can club them and say that, okay, for this category, if it's a cash credits facility or if there's a working capital loan, etc., but you have working capital loans from multiple parties with similar terms, then you can bucket all of them, call them working capital loan from this party, and terms are whatever, repayment terms are this. Okay, another thing that we also observe as errors is when we put the outstanding period, people generally tend to consider outstanding period from the date of the loan, but the disclosure is required from the date of the balance sheet. So up to maturity from the date of the balance sheet. So if it is 31st March 2025 and the balance period is suppose 2 months, that is what comes, not 15 months when the borrowing was done. So be clear of that, because there are some of these mistakes in terms of the Schedule 3 requires you to give the maturity based on your balance sheet date. And again, the number of installments and the amount of installments, all these disclosures are required. The applicable rate of interest is applicable, and any significant relevant terms. So if there are any payment triggers, in terms of, it says that if your ratio goes down, if your current ratio is below 1 or whatever, or if your working capital goes below this, if those triggers are there, it is important for the readers of the financial statements to know that these triggers can have a repayment trigger. So I think those relevant disclosures need to be there in the financial statements. Another challenge that you face is when there are companies who have a lot of, so you call them as repayable on demand, but there again, I mean, obviously the CARO requirement applies, but when it is repayable on demand, you call it as repayable on demand, and you classify it as current. And there again, so there are two types of repayable on demand. One is generally repayable on demand. The second is if there are specific triggers, like I said, if there are some of these ratios which are not, some of these covenants which are there in the borrowings agreement, which says that, okay, these are the covenants that need to be met on an ongoing basis till the loan is settled. So if any of those triggers become applicable, then it might become repayable on demand. So that's when the... So I was coming to where there could be a company which has got multiple debts, etc. There are several debts with multiple terms, multiple repayment periods, multiple dates, multiple compositions, etc. So then in that case, you also need to see, are we having excessive disclosures? At the end of it, we are supposed to make the financial statements user-friendly. The information should be relevant to the users. So you might have to just decide how much of information you really want to disclose. Do you want to bucket all of them and call them as one category and then say, okay, these 4 categories of borrowings and these are the various repayment terms, etc., etc. Or do you want to give like some 10 pages of disclosures around each of those loans and confuse the readers? So there again, that balance, and I think as auditors, we also have a role to ensure that the disclosure is appropriate rather than just having the disclosures in place, which is a significant responsibility on us. So where, it should be presentable, it should be useful to the readers of the financial, with the intent of enabling them to understand the financial statements, not with the intent of just providing information which might not be relevant or might not really be useful to the users. Borrowing secured against current assets, obviously there is this requirement in terms of confirming, whether quarterly returns or statements of current assets have been filed by the company with banks or financial institutions, and whether they are in agreement with the books. And for every quarter, it's not only the year end, but for every quarter it has to be in agreement with the books of accounts. And if not, then obviously the reconciliation has to be there in the financial statements. And wherever there are material discrepancies, you need to provide reasons as to why there are material discrepancies. So generally there is a spread. I mean, I don't think you get loan against 100% of the assets. So you will, the borrowing limit would be 75%, etc. So that should not make a problem. But only thing is where you have to highlight the difference. Why this? If it is purely because of exchange difference, you can mention that in those quarterly returns, because those are unaudited information. Okay, so and it is based on MIS. So you cull out the MIS information, and that's when they do the filing. When you actually do the audit of the year end, you might realize that there were some sales returns, or there were some other adjustments to current assets because of sales returns. Your receivable has come down, etc., etc., etc. So that's why then the real number has actually changed subsequently, or there were some year-end discounts because of which it was pulled back to that quarter, and then the quarter number. So you need to mention why that has changed. So that is the disclosure required. But here again, the intent is not being met. The intent was to see whether there is any misreporting. So these are adjustments in the normal course of business. Giving discounts is in the normal course of business. Year-end related adjustments, sales returns, etc. is part of the normal course of business. The intent was not to capture this. The intent was to see whether I'm misreporting. Like if my current assets is X, am I really showing it as X, or am I inflating it for the purpose of just filing and then playing around with my borrowing capacity? Impairment loss, reversal of impairment loss. As you're aware, Schedule 3 requires us to disclose this separately. There is this para 82 of Ind AS 1 where very specifically impairment losses, including impairment gains or reversal of impairment losses determined as per Ind AS 109 on financial instruments, it needs to be disclosed. So generally people tend to miss this out, because if there are ECL related provisions, etc., then people tend to miss this out. But yes, it is important to disclose this, because people generally club this as a other expenditure. If it's an impairment charge, then they look at it as other expense. It's not separately disclosed. Or if there's a reversal of an impairment loss, then they show it as other income. But if it is material, it is important to show it separately. And here again, the intent with which people club it under other is because they believe that the lenders will look at it very differently. So if I have an impairment loss on a receivable, I might find it difficult to borrow, because I'm having a provision against receivable, so I'm not really running my business operations well. So there is a risk of missing. So people generally tend to hide it under other income, etc. But I think as auditors or as accountants who are professionals, we need to ensure that the compliance is there. And if it is a material amount, I think we should ensure that they are disclosed separately. Benchmark for disclosure of separate line items. Other income, other expenses is general. So obviously, any item of any item of income or expenditure which exceeds 1% of the revenue from operations or 10 lakh rupees, whichever is higher, in addition to the consideration of material. So materiality obviously is based on the benchmark that you have used. You could have either used PBT, or you would have used revenue, or you would have used total assets, depending on the company's operations and what you really believe is an ideal benchmark. So you would have determined that. But in addition to those materiality related disclosures, this is again a mandated disclosure. So you need to be very conscious in terms of ensuring that these disclosures are in place. What happens is, technically, because of this benchmark, you are forced to disclose a lot of things which technically might not be material. So if there are certain companies who operate as an agent, for example, so their income is disclosed on a net basis, but all your expenditure is generally based on a large amount of revenue. So you have a gross revenue which is very high, and all your expenditure is based on that gross revenue, to earn that gross revenue. But because you're acting as an agent, you net off your expenditure and then you show your net income, which is technically your agency income. So that could be challenging, and you might have a lot of clutter around the disclosure. So there again, you need to be careful in terms of how do you is it really excessive information which you're trying to disclose and confuse the readers? So you might want to bucket some of those categories of expenses like freight, forwarding, etc., or call them as legal and professional instead of defining each of those professional expenses, etc. So bucket it under relevant heads so that it becomes useful to the readers of the financial statements. And then the rest of it can be under other income and other expenses. Liabilities, provisions no longer required return back. So as you're aware, operating revenue has to be shown separately, and then there are relevant disclosures around operating revenue, which is like the goods related. What are the type of goods that you've sold, exports, domestic turnover, etc., sale of services, other scrap related. So all of those disclosures are mandated. When it comes to other operating revenue, here again there is a interpretation, like what is other? So when you say other operating revenue, it has to be in some form related to the operations of the company. Like scrap sales is a good example. When it's a manufacturing company, you are manufacturing products. Generation of scrap is ancillary to your operations. So obviously that is other operating revenue. Now, excess provision no longer required. What happens? You have made a provision. in relation to some debtor which was not receivable. But if it gets reversed within a normal period, it still can be okay because the revenue was sitting there, right? The revenue which you actually recorded is there, so it can be offset and shown as other operating. But at the same time, if it has been a long period of time and it is not really possible to establish to which particular line item it related to, it has been sitting there and suddenly after 7 years you decided now, I mean, it's not, it's now established that the person doesn't exist, the person who's supposed to receive the money, or it is not traceable, etc., and then you write it back, then you show it as other income. It doesn't make sense to show it as other operating revenue. And the best way to disclose it is just describe it appropriately. What does it pertain to? And why do you believe it is excess provision? So if you have that, then again from a reader's perspective, the person is clear. Even if that misclassification is there, he knows that this is what it pertains to. I can make my adjustments if I really want to project the numbers of the company. Gratuity expense. So this again, if you really look at Schedule 3, there is, where a separate fund is maintained for gratuity payouts, then contribution to gratuity fund should be disclosed under the subhead contribution to provident and other funds. If you look at gratuity, by nature, it is a defined benefit plan. It's not a defined contribution plan because you have the Payment of Gratuity Act, and basis that you are supposed to pay out gratuity depending on the number of years of service, if the person has completed 5 years, etc., etc. So there are conditions attached. So generally it's a defined because the benefit is defined and basis which, so tomorrow if there's a shortfall, even if you have a gratuity fund, so both ways, I mean, if you contribute to your own fund or if you contribute, you have an insurance policy and an insurer managed funds, either ways if there is a gap, then in that case the gap has to be plugged by you. So it's a defined. But what people believe is if it's a contribution that I've made to LIC or if I have a fund, then it's a defined contribution plan. But that is not the case because the primary nature or the inherent nature of that liability is defined benefit plan. So any shortfall is the company's responsibility. At the same time, there are certain companies who, like for the senior management, for the KMPs, etc., they might have a very different plan, which is tailored. So the Payment of Gratuity Act doesn't apply to them, okay, because of the remuneration. And then they have a very different plan which says that, okay, I will create a fund for you and whatever benefits will flow out of the fund will be yours. So the return that the fund earns and the capital contribution that I've made into the fund, all of that then sits with you. If it is very clearly defined and you can very clearly establish that it is not a defined benefit plan, only then will it be called a defined contribution plan, and then you can show it as contribution to provident fund. Otherwise, provident fund, as you know, is a defined contribution plan. So that because people generally tend to make that mistake, okay, there is a fund created, etc., so I need to show that. So, but the inherent nature of gratuity is a defined benefit plan, so it has to be shown under salaries, wages, and bonus. Disclosure at consolidated financial statement level wherever required. So obviously, as you are aware, the CWIP and intangible assets under development aging schedule has to be shown in standalone financial statements. But obviously, if it is material, and again, materiality will be after considering the consolidated financial statements. So at that level, and this will only happen if at a, you also have other subsidiaries which are material to the overall group. There are large components from where these numbers, if there are Indian components, India domestic components, then you might have to disclose. So security of current assets against borrowings that we spoke about, compliance with approved schemes of arrangements that are there, utilization of borrowed funds and share premium, disclosure pertaining to details of cryptocurrency or virtual currency. As you're aware, we make that statement at the end whether the company has dealt with cryptocurrency or virtual currency, etc. So if these are material from a consolidated financial statement perspective, then you need to make those disclosures. And generally the benchmark is 10% of the respective financial statement line item, FSLI. So if the overall disclosure that is applicable within that financial statement line item, if it is exceeding 10% of that FSLI, then those disclosures need to be made. But here, like one good example is CWIP, for example. CWIP itself is a FSLI, or intangible assets under development itself is a FSLI. So how do you apply the 10% on that? It is basically 100%, right? So that interpretation again is a challenge, but here again, if you follow a conservative approach of really applying it, I mean, an additional disclosure, if it is really material to the users of financial statement, will not harm you. But if it is something that which should have been done and we've not done it, then unnecessarily we'll be in trouble. So, treasury shares with ESOP trust. So a lot of these ESOP schemes that are there, they generally form a ESOP trust where the trust acquires shares from the public, from the market, and then they use those shares for granting it to the employees, whoever is eligible for the employee stock option. So generally what happens is that trust would have acquired those shares from the market. So the funding is done by the company. The company, lends money to the trust, the ESOP trust, and then the trust uses that money to procure shares, by trading in the market, and it buys the company's own shares, and that sits as assets of the trust. Obviously it needs to be consolidated in accordance with the consolidation principles. But here what happens is, now technically the company is owning its own shares, because that gratuity trust is part of the company. It has to be consolidated. So here you have to show it as a net from your equity capital. But obviously it has to be disclosed separately. So whatever is there held by the ESOP trust, you show less shares held by ESOP trust. So 100 rupees is my total equity capital, less shares held by ESOP trust 10, and then we show 90. So again, disclosure is very, very important, so that the reader knows that this 10 rupee adjustment is because of the shares held by the ESOP trust. And whenever it is exercised again, so the grant has happened, the vesting has happened, and then the exercise period is also, within the exercise period, the exercise has happened, then obviously it comes back to your equity capital, because now again it is there as a shareholding with the employee. I think I've tried to cover all of these gray areas where we felt was relevant for us to really understand, and where there were multiple views, there were general discrepancies in presentation, disclosures, etc. Happy to take any more questions. And I hope it was useful in some form at least. Yeah, I think it will be there with WIRC and they will share it with you. Yes. Sorry? Hmm. So it all depends on whether there is a recourse or not. So if it is so no recourse, then the transaction is closed. Now tomorrow you have settled with the bank and then your money is in. So if the transaction is closed, so no recourse means tomorrow if there is a default, the bank cannot come back to you, or the institution cannot come back to you and recover the money, because you have settled at a discount, and that discount is the risk premium and the interest, etc., that the banker or the institution has taken. So at your level, the transaction. But if it is with recourse, then you continue to show that as your liability, and then you show this as a receivable from. Application of what? Huh? But that's not capital WIP. If he's a builder, this will be his inventory WIP, no? But that's a normal inventory WIP. So whatever, I mean, if it is stuck up, if you believe your inventory needs to be provided for whatever reason. So one is, if it is whatever, till the 10th floor you have constructed, it is saleable, there are no issues, then it's fine, you leave it at that. If the rest, if the permission that is awaited and is holding the project back, if that has impact on saleability of those 10 floors, then obviously the inventory also needs to be impaired to the extent required. So if you believe there is an impairment to the extent of 10% because of the perception that is created in the market that this project has been stalled, so obviously there could be challenges in completion, etc. So then to the extent that impairment is required, you need to impair, and then obviously mention why it is impaired. We also have a real estate expert sitting amongst us. Yeah. In case, as he said, if because of this the refund might get triggered because you would have already collected money, depending on the phase of construction. So you already have shown it as a liability in the books. But if the interest liability, so the liability is already sitting in because you've collected the money and you've not even to the extent it has not been applied to revenue, then obviously there is there as a liability. So if you might have to pay interest because if you're refunding with interest. Any more questions, or if you want to share some practical experiences or want to discuss on any practical experiences or difficulties that you would have faced while applying Schedule 3? Sorry, what bills? Bill purchase, huh? Hmm. But you will have to see whether, see, the director is guaranteeing as a representative of the company. It's not as personal. So, huh. So then it will be like a, it's not called as secured if guarantee is the only thing. You need to mention that it is guaranteed. So then you just need to mention that it is, there is a personal, so there is a reference saying that there is a personal guarantee given by the directors. And that's what it is. Any more questions, any more thoughts? Anything that you want to bring to the benefit of the audience in terms of any difficulties you would have faced, presentation, disclosure, information not available in the specific format in which the disclosure needs to be made? Current assets. Yes. That is not, because see, here we are talking about quarterly. So we are talking about the quarterly returns. So one is the general. So there are both. There are companies who do this. There is monthly filing also, but yeah. Which is okay, but here it is a factual disclosure. So this process is fine. But generally what happens is, I mean, most companies, since they are aware of this submission that has to be done on a quarterly basis, so, and it's not even quarterly, it's monthly. So technically you need to file your current asset related submissions by every month. So monthly. So if there is a discrepancy in month one, the general presumption is that when you're doing it at the, because this is a quarter end situation. So the general presumption is over a period of 3 months, the whole reconciliation would have been taken care of. And generally for a quarter, you get a slightly longer period for submission. So the general presumption is that the companies will do that exercise of reconciling everything and set everything right as at the end of the quarter. And then when you do that for each quarter, generally you should not get a discrepancy. But what we have observed is generally the discrepancy is because there is some annual year-end discount, or there is some return that suddenly comes up in relation to that quarter, which was not anticipated. So those are things, or if there is some ECL related provision that suddenly comes up, or some dispute. So that is the only, but the intent was not that. The intent of this particular provision, as we understand, was more to see that is somebody creating a fraud, or is somebody committing a fraud by disclosing wrong numbers. These are, adjustments in the normal course of business. by invoice. Because if you know, the aging is since the time the project has started. So invoice in the sense the day you started the project, so there's a project start date. So based on the project start date, what is the aging? And project start date only, because generally when you're looking at, you estimated that this 5 years is my window for that entire plant construction. Let's look at a plant construction. So I'm looking at a 5 year, and that's my original, plus for that plant construction, if my estimated budgeted cost is 10 crores. So, and we are suppose on year 2, then we say that this is the aging, 2 years is the aging, right, from the project start date. Or the third year, it will be 3 years. Now, our disclosure is, I mean, on two sides. One is, has it exceeded the project timeline? Because the intent is to let the shareholders know that, okay, there are projects which are exceeding the timeline. There is a risk because of which, I might not complete the project, or there could be other issues, etc., etc. So if it is within the timeline, you just give the aging and say that, and then mention that, okay, obviously it is not, because you need to make, so there are categorization between projects in progress and, so you make that disclosure. If it has not exceeded, then it is a simple bucketing. Or if it has exceeded the budgeted cost or the budgeted timeline, then you mention that, okay, it has exceeded by these many years or these many months or by this amount or this percentage as compared to the budget. Percentage is also recommended because people should know, is it like 100% or is it like a 5%? Generally, the variation of 5 to 10% is still deemed okay, so that the reader looks at it in that manner. If there are no more questions, we can wind. Yeah. Various authorities. So I think one is the bank guarantee might also have an end date based on the underlying purpose for which the bank guarantee was given. So if it was for a project with a government or port, for example, for construction of a port, you've given some bank guarantees. The moment that project gets over, it is tied to that. So by default, that bank guarantee will lapse. But if it is an open-ended bank guarantee and it has not been settled, it needs some actions from the company's end and also from the banker's end, and it is stuck because of that, you can just mention that as a fact. Because you, as you said, the margin money has still not come back. Say, since the they've not released the margin money because they've not closed the bank guarantee. So you can mention. But here again, look at the recoverability part of it. The margin money could have been absorbed by the bank for whatever defaults that the company would have committed. There might have been some preconditions for the bank guarantee and the company has not fulfilled those conditions. So obviously that's why they have forfeited. So it might be a situation that that money is not at all recoverable. So whenever you have such situation where the tenor has got over and the margin money has not been received back, please look at it, with some professional skepticism. So government contracts. Yeah. So we know. So this again is what we have to look at. We have to look at the industry practice also. So when you're dealing with government contracts, there is generally a lag in terms of, So I think you look at what's the history, what is the general trend. So in this particular situation, you might have to look at it very differently, saying that this is the market practice, even though it is 6 months overdue or 1 month overdue, it is not bad. It is recoverable. It's only, so I think the relevant documentation needs to be reviewed in terms of the submissions made. Is there any, notice from the government saying that, we are going to be forfeiting this because you've not really met the quality standards or timelines or etc., etc., etc. Good to go? Okay. Thank you very much. I think you've been a great audience.